Question 1. General annuity concepts. What is the primary difference between a fixed annuity and a variable annuity? A fixed annuity offers payouts based on the performance of the stock market, while a variable annuity guarantees fixed payouts. B. A fixed annuity provides a guaranteed interest rate, while a variable annuity offers payouts based on the performance of selected investments. C. A fixed annuity allows for tax-deferred growth, while a variable annuity does not. D. A fixed annuity provides payouts for a limited time period, whereas a variable annuity provides lifetime income. Answer: B. A fixed annuity provides a guaranteed interest rate, while a variable annuity offers payouts based on the performance of selected investments. Explanation: Fixed annuities provide a guaranteed interest rate and predictable income payments regardless of market conditions. These annuities are less risky and suitable for conservative investors. Variable annuities, on the other hand, link the annuity payouts to the performance of underlying investments such as mutual funds or other market-based products, meaning that the value of the annuity can fluctuate with the market. Option A is incorrect because it confuses the nature of variable annuities. They do not guarantee fixed payouts. Option C is incorrect as both types allow for tax-deferred growth. Option D is inaccurate as both fixed and variable annuities can provide lifetime income depending on the payout options chosen. Question 2. Annuity products and features. Which of the following is a key feature of equity-indexed annuities? A. They provide returns based on a fixed interest rate. B. They allow the annuity owner to invest directly in the stock market. C. They offer a return that is linked to a stock market index with participation rates, caps, and floors. D. They guarantee a fixed monthly payment regardless of market performance. Answer: C. They offer a return that is linked to a stock market index with participation rates, caps, and floors. Explanation: Equity-indexed annuities (IAs) are designed to provide returns based on the performance of a stock market index, e.g., the S&P 500, but with certain protections such as caps, maximum return, and floors, minimum return, which help limit the risk exposure. Option A is incorrect because the IAs do not provide a fixed interest rate like fixed annuities. Option B is incorrect because the annuity holder does not directly invest in the stock market, but rather has their returns linked to the performance of an index. Option D is also incorrect because the IAs do not guarantee a fixed monthly payment, unlike fixed annuities. Question 3. Scenario-based question: Annuity sales and marketing. Mr. Thompson is a 60-year-old investor who has recently sold his business and is looking for a way to generate reliable retirement income. He is considering purchasing an annuity but is unsure about the best option for his needs. He has a moderate risk tolerance and is concerned about outliving his savings. As his financial advisor, which of the following would be the most suitable annuity recommendation for Mr. Thompson? A fixed immediate annuity with lifetime income payments. B. The variable annuity with a guaranteed minimum withdrawal benefit, a deferred annuity with flexible premiums and surrender charges. D. A fixed deferred annuity with a lump sum premium payment and no rider options. Answer: B. A variable annuity with a guaranteed minimum withdrawal benefit. Explanation: Given that Mr. Thompson has a moderate risk tolerance and is concerned about outliving his savings, a variable annuity with a guaranteed minimum withdrawal benefit would be suitable. The GMWB rider allows him to receive a minimum income regardless of how the underlying investments perform, while still providing the opportunity for market-based growth. Fixed immediate annuities are a valid option for guaranteed lifetime income, but they do not provide investment growth potential, which may be less appealing for someone with moderate risk tolerance. Deferred annuities (C) typically have longer accumulation periods, which may not align with Mr. Thompson's need for near-term income. Fixed deferred annuities (D) would also provide stable income but lack the flexibility and growth potential of variable annuities. They are generally more suitable for someone with a very low risk tolerance and would not address Mr. Thompson's concerns about market risk and outliving his savings as effectively as the GMWB option. Question 4. Annuity calculations and valuations. Which of the following statements correctly explains the relationship between the present value (PV) and future value (FE) of an annuity? A. The present value of an annuity is always greater than its future value. B. The future value of an annuity depends on the interest rate and the length of the payment period. C. The present value of an annuity equals its future value if the interest rate is 0. D. The future value of an annuity is always less than its present value. Answer B. The future value of an annuity depends on the interest rate and the length of the payment period. Explanation: the future value FE of an annuity is influenced by the interest rate and the length of time the payments are made. A higher interest rate or longer time period increases the future value of the annuity as the payments grow with interest over time. Option A is incorrect, as the present value can be greater or smaller than the future value depending on the interest rate and time. Option C is incorrect, because when the interest rate is zero, the present value and future value would be equal, but this is not a general rule for all situations. Option D is incorrect, because the future value can exceed the present value depending on the interest rate and the time over which the annuity payments are made. Question 5. Taxation of annuities. Which of the following is true about the taxation of non-qualified annuities during the withdrawal phase? A. The entire withdrawal is subject to ordinary income tax. B. Only the principal amount is taxed as ordinary income. C. Only the earnings, interest, dividends, or capital gains are taxed as ordinary income. D. The withdrawals are not taxable because the annuity was purchased with after-tax dollars. Answer C. Only the earnings, interest, dividends, or capital gains are taxed as ordinary income. Explanation: non-qualified annuities are purchased with after-tax dollars, meaning that the principal amount is not taxed when withdrawn. However, any earnings from the annuities, such as interest, dividends, or capital gains, are subject to ordinary income tax when withdrawn. This is often referred to as the last in, first out LIFO rule, where earnings are considered to be withdrawn first. Option A is incorrect, because only the earnings are taxed, not the entire withdrawal. Option B is incorrect, because the principal is not taxed upon withdrawal, only the earnings. Option D is incorrect, because while the annuity was purchased with after-tax dollars, the earnings are still taxable. Question 6. Annuity surrender and withdrawal options. What is a key disadvantage of surrendering an annuity early, particularly during the surrender charge period? A. The annuity holder will forfeit any tax-deferred growth. B. The annuity holder may incur significant surrender charge, reducing the value of the withdrawal. C. The annuity holder will be required to pay taxes on the principal amount. D. The annuity holder will lose the right to access any funds in the future. Answer B. The annuity holder may incur significant surrender charge, reducing the value of the withdrawal. Explanation: surrender charges are fees that an annuity holder may incur if they withdraw funds during the early years of the annuity contract, typically within the surrender charge period. These charges can be quite substantial and reduce the value of the withdrawal. Option A is incorrect, because the tax-deferred growth is not forfeited, but the surrender charge is a separate fee. Option C is incorrect, as taxes on the principal are not due unless the annuity is cashed in, and even then it is the earnings, not the principal, that are taxed. Option D is incorrect, as annuity holders typically retain access to their funds, though subject to penalties or charges during the surrender period. Question 7. Annuity sales and marketing. Which of the following would be considered a violation of the suitability requirements when recommending an annuity to a client? A. Recommending a fixed annuity to a client who has a high tolerance for market risk. B. Recommending a variable annuity to a client who is concerned about market volatility and prefers predictable income. C. Recommending a deferred annuity to a client who needs immediate income for living expenses. D. Recommending a fixed indexed annuity to a client with a short-term investment horizon. Answer B. Recommending a variable annuity to a client who is concerned about market volatility and prefers predictable income. Explanation: suitability requirements dictate that the recommended annuity should align with the client's financial needs, goals, and risk tolerance. In this case, recommending a variable annuity to a client who is concerned about market volatility and prefers predictable income violates suitability standards, as variable annuities are subject to market risk and offer variable returns, which may not meet the client's need for stable, predictable income. Option A is not necessarily a violation, as a fixed annuity is suitable for someone with a high tolerance for risk, offering guaranteed returns with no market exposure. Option C is incorrect, because deferred annuities are typically not suitable for clients needing immediate income. However, the scenario does not necessarily represent a violation of suitability if the client is okay with waiting for income to begin. Option D is incorrect, because a fixed indexed annuity can be suitable for clients with a medium to long-term investment horizon, as it provides market-linked returns with some protection against downside risk. Question 8. Annuity retirement planning. How does an annuity help mitigate longevity risk in retirement planning? A. An annuity guarantees a fixed interest rate for the entire retirement period, protecting against inflation. B. An annuity provides a lump sum payment at the start of retirement, ensuring financial security. C. An annuity offers regular income payments, regardless of how long the retiree lives. reducing the risk of outliving savings. D. An annuity invests the principal in stocks to ensure maximum returns throughout retirement. Answer C. An annuity offers regular income payments regardless of how long the retiree lives, reducing the risk of outliving savings. Explanation: the primary benefit of an annuity in retirement planning is to provide guaranteed lifetime income, which ensures that the retiree does not outlive their savings. This addresses longevity risk, the risk that a person will live longer than their savings will last. Option A is incorrect because while some annuities may offer a fixed interest rate, they do not typically protect against inflation, which is an important factor to consider in long-term retirement planning. Option B is incorrect because a lump sum payment does not address the risk of outliving savings, as the funds can be depleted over time. Option D is incorrect because while annuities may have investment options, the primary purpose is to provide regular income rather than to maximize returns through stock market investment. Question 9. Ethics and professional responsibility. Which of the following actions by an annuity agent would be a violation of ethical standards? A. Recommending an annuity product that is highly complex without fully explaining the associated risks to the client. B. Explaining all available annuity options to a client, including the risks and benefits of each. C. Providing a clear written disclosure of the agent's compensation arrangements to the client. D. Offering an annuity that is appropriate for the client's needs but with a higher than average commission. Answer A. Recommending an annuity product that is highly complex without fully explaining the associated risks to the client. Explanation: an ethical violation occurs if an agent recommends a product without fully disclosing the risks, especially if the product is complex. Full disclosure of risks is required to ensure that the client understands what they are purchasing. Option B is ethically sound as the agent is providing the client with all necessary information to make an informed decision. Option C is also ethically correct as agents are required to disclose their compensation arrangements to avoid conflicts of interest. Option D is not an ethical violation if the annuity is appropriate for the client's needs even if the commission is higher. However, excessive commissions may raise concerns, but this does not necessarily constitute an automatic violation of ethical standards. Question 10. Annuity types and features. Which of the following types of annuities allows the annuitant to choose how their premiums are invested with the potential for higher returns but also greater risk? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Fixed indexed annuity. Answer B. Variable annuity. Explanation: a variable annuity allows the annuitant to choose from a range of investment options such as mutual funds, stocks, or bonds. The value of the annuity fluctuates based on the performance of these investments, meaning there is the potential for higher returns, but also greater risk. Option A is incorrect because a fixed annuity provides a guaranteed return, regardless of market performance. Option C is incorrect as an immediate annuity is focused on providing income payments right away, and its returns are typically fixed or based on a predetermined formula. Option D is incorrect as a fixed indexed annuity links returns to a stock market index but with a cap on the potential gains, limiting the investment risk compared to a variable annuity. Question 11. Taxation of annuity distributions. What is the tax treatment of an annuity payout when the annuity holder is receiving payments under a qualified plan such as an IRA? A. The entire payout is tax-free. B. The principal is taxable but the interest is tax-free. C. The entire payout is subject to ordinary income tax. D. Only the earnings portion of the payout is subject to capital gains tax. Answer C. The entire payout is subject to ordinary income tax. Explanation: qualified annuities are purchased through tax-deferred accounts like IRAs, 401(k)s, or other retirement plans. When payouts begin, both the principal and the earnings are subject to ordinary income tax because the tax deferral applies only until the funds are withdrawn. Option A is incorrect because qualified annuities are not tax-free. They are taxed as ordinary income when payouts are made. Option B is incorrect because both the principal and the earnings are taxable in a qualified annuity. Option D is incorrect as the capital gains tax does not apply to annuity payouts. Instead, they are taxed as ordinary income. Question 12. Annuity withdrawal penalties. Which of the following scenarios would likely result in a penalty when withdrawing funds from an annuity? They withdrawing funds after age 591 were from a non-qualified annuity. B. Withdrawing funds from a qualified annuity before age 591 were. C. Taking systematic withdrawals from a fixed annuity after the surrender period. D. Withdrawing a lump sum from a fixed indexed annuity after the surrender period ends. Answer B. Withdrawing funds from a qualified annuity before age 591. Explanation: withdrawals from qualified annuities before the age of 591 were subject to a 10% early withdrawal penalty in addition to ordinary income taxes, unless an exception applies, such as disability or certain medical expenses. Option A is incorrect because there is no early withdrawal penalty for non-qualified annuities after age 591. Option C is incorrect because systematic withdrawals after the surrender period generally do not incur penalties. Option D is incorrect because surrender charges apply only during the surrender period, not after it ends. Question 13. Annuity surrender charges. What is the purpose of a surrender charge in an annuity contract? A. To encourage the annuity holder to hold the annuity for a longer period to benefit from its full features. B. To reimburse the insurer for any commissions paid to the agent. C. To prevent the annuity holder from withdrawing all their funds during the first year. D. To guarantee that the annuity will always have a positive return. Answer A. To encourage the annuity holder to hold the annuity for a longer period to benefit from its full features. Explanation: surrender charges are designed to discourage early withdrawals and incentivize the annuity holder to keep the annuity for a longer period. These charges typically decrease over time, often disappearing after 7 to 10 years, as the annuity holder benefits from the product's features. Option B is incorrect because surrender charges are not primarily intended to reimburse the insurer for commissions. Option C is incorrect because the surrender charge is not specifically designed to prevent full withdrawals but to discourage early cash outs. Option D is incorrect because surrender charges do not guarantee a positive return and they are simply fees for early withdrawals. Question 14. Annuity payment options. Which of the following annuity payment options provides the highest amount of income to the annuitant, but only as long as the annuitant is alive? A. Life annuity with period certain. B. Joint and survivor annuity. C. Single life annuity. D. Life annuity with refund option. Answer C. Single life annuity. Explanation: a single life annuity provides the highest income payments to the annuitant, but the payments stop upon the annuitant's death. This is the highest payout option because there are no additional guarantees for beneficiaries. Option A is incorrect because a life annuity with period certain provides payments for a certain period even if the annuitant dies before the period ends, reducing the monthly payments. Option B is incorrect because a joint and survivor annuity provides income for two people, usually a spouse, and the payments may be lower than a single life annuity to account for the second person's lifetime. Option D is incorrect because a life annuity with refund option provides the annuitant with payments for life, but if they die early, the remaining principal is refunded to their beneficiaries, resulting in lower monthly payments. Question 15. Annuity contracts and beneficiaries. Which of the following describes the beneficiary option for an annuity with a contingent beneficiary designation? A. The annuity's payments will stop upon the death of the primary beneficiary. B. The annuity continues to make payments to the contingent beneficiary if the primary beneficiary dies. C. The contingent beneficiary will only receive a lump sum payout upon the annuitant's death. D. The contingent beneficiary will receive payments for a fixed period only. Answer B. The annuity continues to make payments to the contingent beneficiary if the primary beneficiary dies. Explanation: a contingent beneficiary is a person designated to receive benefits from the annuity if the primary beneficiary dies before receiving all their payments. This ensures that the annuity continues making payments to the contingent beneficiary without disruption. Option A is incorrect because the payments do not stop. They will go to the contingent beneficiary if the primary one dies. Option C is incorrect because a contingent beneficiary typically continues to receive the annuity payments, not a lump sum. Option D is incorrect because a contingent beneficiary is not limited to a fixed period but can continue to receive the same benefits as the primary beneficiary. Question 16. Inflation and annuities. Which of the following features of an annuity helps protect the annuitant against inflation? A. A fixed interest rate. B. A cost of living adjustment, COLA. C. A fixed payment amount. D. A guaranteed minimum payout. Answer B. A cost of living adjustment, COLA. Explanation: a cost of living adjustment, COLA, increases the annuity payment each year to keep pace with inflation. This feature helps protect the annuitant's purchasing power over time. Option A is incorrect because a fixed interest rate does not adjust to inflation and will provide the same return regardless of inflation rates. Option C is incorrect because a fixed payment amount provides a set payment that does not increase with inflation. Option D is incorrect because a guaranteed minimum payout does not account for inflation. It simply ensures that the annuitant will receive at least a minimum amount. Question 17. Annuity payout phases. What is the primary difference between the accumulation phase and the distribution phase of an annuity? A. The accumulation phase involves withdrawing money from the annuity, while the distribution phase involves making deposits. B. The accumulation phase involves growing the annuity's value, while the distribution phase involves taking income payments. C. The accumulation phase is only applicable to fixed annuities, while the distribution phase applies to variable annuities. D. The accumulation phase is the first stage of the annuities contract, but the distribution phase is optional for the annuitant. Answer: B. The accumulation phase involves growing the annuity's value, while the distribution phase involves taking income payments. Explanation: during the accumulation phase, the annuity's value grows through premiums and interest or investment returns. In the distribution phase, the annuitant begins receiving periodic payments from the annuity. Question 18. Annuity types. Immediate versus deferred. Which of the following best describes a deferred annuity? A. An annuity that begins making payments immediately after the premium is paid. B. An annuity that provides payments after a specified period of time has passed. C. An annuity that guarantees fixed payments for the annuitant's life. D. An annuity that is sold exclusively by banks. Answer: B. An annuity that provides payments after a specified period of time has passed. Explanation: a deferred annuity allows the annuitant to accumulate funds for a set period of time before beginning to receive payments. This is different from an immediate annuity, where payments begin immediately after the premium is paid. Option A is incorrect because it describes an immediate annuity, where the first payment is made soon after the premium is paid. Option C is incorrect because it refers to a life annuity, which could apply to either immediate or deferred types. Option D is incorrect, as annuities can be sold by various financial institutions, not just banks. Question 19. Annuity beneficiaries. What is the effect of naming a primary beneficiary and a contingent beneficiary in an annuity contract? A. The contingent beneficiary will receive annuity payments only if the primary beneficiary dies during the payout period. B. The primary beneficiary will receive higher payments than the contingent beneficiary. C. The contingent beneficiary will receive a lump sum payment if the primary beneficiary dies. D. The contingent beneficiary has no rights to the annuity payments unless the primary beneficiary dies during the accumulation phase. Answer: A. The contingent beneficiary will receive annuity payments only if the primary beneficiary dies during the payout period. Explanation: the primary beneficiary is the first to receive payments, and if they die, the contingent beneficiary will then receive the payments. This ensures that the annuity continues even if the primary beneficiary passes away during the payout phase. Option B is incorrect because the amount of payments is generally the same for both primary and contingent beneficiaries. Option C is incorrect because the contingent beneficiary typically continues receiving payments, not a lump sum. Option D is incorrect because the contingent beneficiary's rights come into play during the payout phase, not the accumulation phase. Question 20. Annuity payout options. Which of the following payout options guarantees the annuitant a fixed monthly income for life and also provides a benefit to a beneficiary if the annuitant dies early? A. Life annuity. B. Joint and survivor annuity. C. Life annuity with period certain. D. Fixed indexed annuity. Answer: C. Life annuity with period certain. Explanation: a life annuity with period certain provides guaranteed payments for a specified period, e.g., 10 years, even if the annuitant dies before the period ends. This ensures that the annuitant's beneficiary receives payments if the annuitant dies prematurely. Option A is incorrect because a life annuity only pays while the annuitant is alive and provides no benefit if the annuitant dies early. Option B is incorrect because a joint and survivor annuity provides payments for both spouses or two people, but it doesn't offer the period certain feature. Option D is incorrect because a fixed indexed annuity provides returns based on an index but does not have a specific payout structure tied to death benefits. Question 21. Annuity taxation. If an annuitant receives monthly payments from an annuity purchased with after-tax dollars, how are these payments taxed? A. The entire payment is subject to ordinary income tax. B. Only the interest or earnings portion of the payment is subject to tax. C. The principal is taxed, but the earnings are tax-free. D. Both the principal and interest are tax-free. Answer: B. Only the interest or earnings portion of the payment is subject to tax. Explanation: if the annuity was purchased with after-tax dollars, non-qualified annuity, only the interest or earnings portion of the payment is subject to ordinary income tax while the principal portion is not taxed. Option A is incorrect because only the earnings portion is taxable. Option C is incorrect because the principal is not taxable, only the earnings portion. Option D is incorrect because the principal portion of the payment is not taxed. Question 22. Surrender charges. What happens if an annuitant withdraws money from an annuity during the surrender period? A. The withdrawal is allowed without penalty. B. The annuitant will incur a surrender charge, reducing the amount of money they can access. C. The annuity contract is voided and the annuitant receives no payments. D. The annuitant will be required to pay a fixed fee regardless of the withdrawal amount. Answer: B. The annuitant will incur a surrender charge, reducing the amount of money they can access. Explanation: during the surrender period, which typically lasts several years, withdrawing funds from the annuity usually results in a surrender charge. This charge reduces the amount of money the annuitant can withdraw. Option A is incorrect because withdrawals during the surrender period typically incur penalties. Option C is incorrect because the annuity contract is not voided, but the annuitant may face penalties. Option D is incorrect because the surrender charge is a percentage of the withdrawal amount, not a fixed fee. Question 23. Annuity riders. What is the purpose of an annuity rider that includes a guaranteed minimum income benefit? GMIB. A. To guarantee a minimum rate of return on the annuity's principal. B. To guarantee that the annuitant will receive at least a certain level of income regardless of investment performance. C. To provide a lump sum death benefit to the beneficiary. D. To allow the annuitant to increase their monthly payments at any time. Answer: B. To guarantee that the annuitant will receive at least a certain level of income regardless of investment performance. Explanation: a guaranteed minimum income benefit (GMIB) rider ensures that the annuitant will receive a minimum level of income even if the annuity's investment returns do not perform well. Option A is incorrect because GMIB does not guarantee a fixed rate of return, only a minimum income level. Option C is incorrect because a GMIB rider is not related to a death benefit but to income guarantees. Option D is incorrect because a GMIB rider does not provide the flexibility to increase monthly payments at will. Question 24. Annuity payments. Which of the following is true about annuity payments? A. Annuity payments are always the same for the life of the contract. B. Annuity payments can vary depending on the performance of the underlying investments. C. Annuity payments are guaranteed only for a fixed period. D. Annuity payments can never be reduced regardless of market performance. Answer: B. Annuity payments can vary depending on the performance of the underlying investments. Explanation: in variable annuities, payments fluctuate based on the performance of the underlying investments, meaning they can go up or down over time. Option A is incorrect because not all annuity payments are the same, especially with variable annuities. Option C is incorrect because some annuities, such as life annuities, provide payments for the annuitant's life, and not just a fixed period. Option D is incorrect because in variable annuities, payments are subject to market conditions and can be reduced. Question 25. Annuity payouts and beneficiaries. Which of the following will cause an annuity to end prematurely, potentially affecting the beneficiary's payments? A. The annuitant reaches the age of 100. B. The annuitant dies before the payout phase begins and no beneficiary is named. C. The annuitant takes out a partial withdrawal during the accumulation phase. D. The annuitant decides to change the payout option after beginning the distribution phase. Answer: B. The annuitant dies before the payout phase begins and no beneficiary is named. Explanation: if the annuitant dies before the payout phase begins and there is no beneficiary named, the annuity contract may terminate and no benefits will be paid out. Option A is incorrect because reaching the age of 100 typically does not affect the annuity contract unless specific conditions are outlined. Option C is incorrect because a partial withdrawal during the accumulation phase does not necessarily end the contract, although it may affect the value. Option D is incorrect because changing the payout option after beginning the distribution phase may be allowed depending on the contract terms, but it does not necessarily end the annuity. Question 26. Annuities and retirement plans. Which of the following retirement plans can include an annuity as a payout option? A. 401k plan, B. 403b plan, C. IRA, D. All of the above. Answer: D. All of the above. Explanation: annuities can be used as payout options for retirement plans such as 401k, 403b, and IRAs when the individual is ready to start receiving income in retirement. 401k and 403b plans allow for the option to purchase annuities as a way to provide lifetime income after retirement. IRAs can also be used to purchase an annuity, often in the form of a traditional IRA or Roth IRA, allowing for either fixed or variable annuity options to begin once the individual reaches retirement age. Question 27. Annuities and inflation. What feature of an annuity protects the annuitant against inflation? A. Fixed payments that never change. B. Inflation protection rider. C. Variable interest rates tied to the stock market. D. A decreasing benefit that adjusts with market conditions. Answer: B. Inflation protection rider. Explanation: an inflation protection rider can be added to an annuity to help protect the purchasing power of the annuity payments against inflation. This rider typically increases the annuity payments periodically to keep pace with inflation. Option A is incorrect because fixed payments do not adjust for inflation. Option C is incorrect because variable annuities are based on market performance but are not specifically designed to protect against inflation. Option D is incorrect because a decreasing benefit would not protect against inflation but rather reduce the payout over time. Question 28. Annuity withdrawals. What happens if an annuitant withdraws money from their annuity before reaching the age of 590 on way? The withdrawal will be subject to a penalty but only on the earnings. B. The annuity will automatically cancel and the principal is returned. C. No penalties will apply as long as the withdrawal is below a certain amount. D. The annuitant will incur 10% penalty on both the principal and earnings. Answer A. The withdrawal will be subject to a penalty, but only on the earnings. Explanation: if the annuitant withdraws money from an annuity before reaching the age of 591, where they will typically incur a 10% penalty on the earnings portion of the withdrawal, but not the principal. Option B is incorrect because the annuity will not automatically cancel, only the penalty applies to early withdrawals. Option C is incorrect because withdrawals, regardless of amount, typically face penalties before age 591. Option D is incorrect because only the earnings are penalized, not the entire withdrawal. Question 29. Annuity purchase methods. Which of the following is a method used to purchase an annuity? A. Single premium payment. B. Periodic premium payments. C. Combination of single premium and periodic premium payments. D. All of the above. Answer: D. All of the above. Explanation: annuities can be purchased in several ways, including single premium, a lump sum payment, periodic premiums, regular payments over time, or a combination of both. Option A refers to a single premium annuity where the annuitant makes a one-time lump sum payment. Option B refers to an annuity purchased with regular periodic payments. Option C refers to a hybrid model where both a lump sum and periodic payments are used. Question 30. Surrender charges and annuities. What is the typical consequence of surrendering an annuity early within the surrender charge period? A. The annuity's value will be increased by an early withdrawal bonus. B. A penalty will be assessed that reduces the amount the annuitant can withdraw. C. The annuity will automatically convert to a higher payout option. D. The annuity will be taxed as ordinary income regardless of earnings. Answer: B. A penalty will be assessed that reduces the amount the annuitant can withdraw. Explanation: surrender charges are applied to annuities if the annuitant withdraws funds during the surrender period, typically 510 years. The penalty is a percentage of the amount withdrawn, reducing the overall value of the withdrawal. Option A is incorrect because early withdrawal typically does not come with a bonus. Option C is incorrect because the annuity will not automatically convert to a higher payout option. Instead, the penalty is assessed. Option D is incorrect because while annuity earnings may be taxed as ordinary income, the surrender charge is a separate penalty and does not trigger automatic taxation.